Hey, what's up guys? Houston here. Let me ask you, have you guys ever received one of these in the mail? Okay. Now, what this is a corporate kit. All right. Now, the reason that I'm telling you all this is because many people, they get confused about LLCs and C corporations. Okay. Now, here's the thing about it. A lot of people don't understand why a C corporation may be more beneficial than an LLC. So what I'm going to do, I'm going to explain to you so that you can understand why one may be more beneficial to you than the other. Most of the time, when we decide, I should say, to set up our businesses, one of the things, we may go to an attorney, a CPA, we may go online or something like that. And the first thing they'll tell us to do is set up an LLC, right? So they tell us to set up an LLC. However, they never tell us why they prefer us to set up an LLC. Here's the thing about it. You have your LLC, you have your C Corp, right? Okay. So you can understand this, all right? Now, most of the time, when you go to your attorney, all right, or your CPA or somebody online, and you say, well, I want to start a business. And they say, well, you should start an LLC. 90% of the time, and this is for most people that have businesses, 90% of the time, what they're thinking about is avoiding taxes. Right? This is why they'll tell you to structure yourself as LLC. All right. Now, another thing that they would tell you to do is cause liability. Right? They'll tell you because of liability. Now, here's the thing that they don't get. Your whole purpose of starting your business is for growth. All right. So we're going to put growth over here. And I want you all to remember this word because this is very important. There's a lot of CPAs, attorneys, a lot of people on YouTube, and they're very good at their job. All right. Now, please understand, I'm not an attorney. I'm not a CPA. I'm not a registered agent with the IRS. However, one of the things that I do know in terms of when it comes to raising capital for your business, I understand what structure is best. All right. Now, here's the thing about it. Most people, they think about the liability. So if you are a Uber, Lyft type of driver, those type of drivers, now they're being targeted, right? Because there's attorneys saying that, hey, if your Uber or Lyft driver assaulted you or they drove off with your belongings and did not return them and things of that nature, you can sue these guys, right? Now, most people that are in the side gig economy, they're not operating with their EIN. They're operating with their SSN, okay? Now, because you're operating with your SSN, your tax rate will go up, right? Now, here's something I want you all to understand. Most people, when they have an LLC, one of the things about it, and you work a job, you have to marry the two incomes together. And so when you marry the two incomes together, it can possibly push up your adjusted gross income. Now, some people will say, well, Houston, what about writing off expenses and everything? Hey, I'm going to get to that, but you have to understand this. When your LLC makes revenue in the business, it has to pass on to the shareholders. So that's whether it's one shareholder or a multitude of shareholders. Now, I'll tell you something else that many tax attorneys or CPAs may not share with you. Say that you have an LLC. Once you have over 100 employees, guess what? You have to switch over to a corporation, right? They don't share that information with you. Now, That being said, like I said, I'm not a CPA, I'm not an attorney, I'm not a registered IRS. It's just things that I've known, I've learned, I've been in the industry over 2 decades. So one of the things about it, like I said, for most people, when they start an LLC, they're looking for the purpose of taxes. But most of the time, when we start our LLCs or C corporation, the biggest challenge we have is funding. Funding, that's right. This is our biggest issue, all right? So if this is our biggest issue, then why do attorneys, CPAs, continue to push us into something that's going to limit us for its growth in funding? The reason they do this because many of them, they're not familiar with the funding process. They may be familiar with filing paperwork, but when it comes to actually growth and funding, that's not their situation. All right. So this is why most people end up in an LLC. Now, are there benefits to an LLC? Absolutely. And we're going to talk about that. Like I said, one of the things you have to understand, if you work a job and you have an LLC business, you have to marry the 2 incomes, right? And that can possibly push up your adjusted gross income. All right. Please be very careful with the words that I'm saying so you can understand. I said possible. All right. Now, here's the thing about it that most people get caught up with LLCs, all right, or S corporations and stuff like that. In terms of they have a perpetuity date. All right. So say that every 30 years, it's so many years, okay, that the LLC ends up dying anyway. Where with the corporation, it can live forever. So you have to ask yourself, do I want to build something to build a legacy, or do I want to build something and then have it restart over? Now, here's the thing about it. I know a lot of people, they go out and they'll buy a chef corporation, okay? And they'll buy a chef corporation assuming that that's going to help them get qualified for funding. However, most of the time with chef corporations, many of these people that sell these corporations, they don't keep up with the taxes. They don't keep up with the bank statements. Okay. So because they don't keep up with the taxes and the bank statement, what ends up happening, you just end up starting over from scratch. Right. And I'll tell you another thing. Even if you're in a state that doesn't charge state taxes, that doesn't mean you don't have to file, right? And you can actually be penalized. And there's another thing that you need to understand. Whatever state your liability is created in, so say that you stay in California and your company's in Nevada. If that liability is created in California, those California laws could supersede your corporation state tax, and you can be penalized on that. Let me say that again, okay? Like I said, if you have a liability in California with your company, but you're in the state of Nevada, your business registered in the state of Nevada, okay? California state laws may supersede Nevada state laws, and you still can be penalized on the liability, okay, off of California laws, not Nevada laws, okay? So that's something you definitely want to sit down with your CPA and attorney, make sure they explain this to you, all right? Because a lot of people, they're going to Wyoming, Delaware and stuff, assuming that they're protected and stuff. But again, whatever state that liability is created in, that state laws may supersede where the company is actually registered. All right. So, and like I said, check with your CPA attorney to make sure. Now, here's another thing about it. Because you're an LLC and you have a job, you're marrying the 2. All right. Now, people do this, again, because they're trying to minimize their taxes. So because they're trying to minimize their taxes, they increase their expenses and stuff. And so they end up taking a loss so they won't pay any taxes. Is that a good thing? Well, the reality of it, it's not. Here's the reason why. Whenever you go to an institution and you're trying to get funding, what ends up happening is that they're going to ask, even if you have bad credit, they'll ask, well, you have a company? Yes, I have a company. You have revenue sales? Yes. Did you have net profits? No. Okay. When you show and expose yourself as showing no net profits in the company, now it's up to them in the underwriting process to see if they actually want to extend funding or lending to you. All right. And most people don't get, and this is the reason I tell people, don't show a loss in the business. You always want to be profitable. I don't care if it's even a small net profit in the business. You always want to show growth in the business. All right. Because again, this puts you in a better position so that you can get qualified for funding. Okay. Now, here's some things that you need to know. All right. We talked about merging with the W-2 income tax and stuff like that. You have a higher chance of an audit with this LLC. And most people are not aware of that. That's another thing. And the reason is because I said earlier, because many people, they'll overstate their expenses. Okay. And because they overstate their expenses, especially like with mileage and things of that nature, what ends up happening, it triggers the IRS to say, hey, what's going on here? And remember the Trump tax laws and stuff? And so everybody went out and they got an LLC and stuff like that. So they started writing off all these mysterious, finding all these mysterious write-offs and stuff like that. Well, the Trump tax laws are going to be expiring. All right. Now, again, like I said, this could trigger an audit when you overstate your expenses. You have to be very careful of this. Hard to transfer the company, meaning that when you say that you want to raise money, okay, so say that you operating as an LLC. Like if you know this Shark Tank and stuff, when they're buying companies and stuff like that, sometimes they will ask what type of structure the company is. You know, what's the business doing, what's the numbers are and stuff like that. Many of those deals do not go through. The reason they don't go through is because of these pass-through structures. Most VCs, venture capitalists, don't like pass-through structures, okay? They don't like them, all right? It's too complicated. Too many hands in the pot, as they say, or whatever. So with LLC, trying to transfer it from one individual to the other makes it more challenging. Okay, so that's the reason I tell people you really want to pay attention to the type of structure that you're actually setting up for your business, especially if you're going for funding. All right, if you're going for funding, you definitely want to pay attention to that. Now, I know a lot of people that's in real estate, that's in Airbnb and stuff like that, and they've jumped into LLCs and stuff. However, they're not understanding that you have more exposure with the LLC versus the C corporation. And we're going to talk about the benefits of a C corporation in a minute. But you have to understand that a lot of your CPAs and attorneys, they'll just push the paperwork, but they don't give you the education of why one is more beneficial than the other. All right. Now, like I said, one of the biggest challenges when it comes to LLCs is raising capital. That's right. We're raising capital. So what that means is that I tell people when you go to the bank, all right, and you're a one owner LLC, when you go to the bank with your LLC, most of the times, if you don't have large deposits and stuff, banks become more conservative because, again, this is where that word comes from, growth. They don't look at you as a growth company, right? They look at you as more of a personalized company instead of a growth company, even though you may have employees and all of these things as well. What? You want to say hi? Come here. You say hi. Say hi. Say hi, everyone. All right. So, all right. You can get back down and go play. All right. She just wanted to be on camera. She hasn't been on camera in a while. Now, again, when it comes to financial institutions, again, the type of institution really matters. That's the reason that I tell you guys that there's 4 levels of funding. So you have your tier 1, okay? So this is like your major banks. This is like Amex, Chase, BOFA, right? So you notice when you try to go get credit cards and stuff and you're a new business and stuff, they're more restrictive most of the time if you don't have a high income or high revenue in the business. Usually, they're going to go anywhere from $3,000 maximum starting out. Usually for a business, they'll go up to $10K. Okay? So this is on the tier 1. All right? Now, on your tier 2, when it comes to funding under this here, all right? And this is for both sides in terms of the tier type of funding, but you need to understand this. So your tier 2, those are your regional and your community banks, right? So those would be like First National Bank of Omaha. That would be like your PNC. Okay, Truist. All right. Now, here's the thing about it. This is why I tell people about the 90-day rule. There's a 90-day rule. When you start a new business, you want to start your bank account, open up your bank account with these 2. All right. There's actually 3 bank accounts you want to start with. However, you do not want to apply for funding with your tier 1 first. You want to start with either your tier 2 or your tier 3 funding. So what that means is, like, usually after 90 days, you're going to start applying for credit cards and things of that nature. So when you start applying for credit cards and stuff like that, then what ends up happening, all right, they, on the tier 2 level, they're going to start you usually between 5 up to 25K. They're more open to you, okay? But it's usually after 90 days. Now, there's a few keys in terms of the 90-day rule. I always tell people you want to open up a personal account, a savings account, a CD, and a business account. The CD is important because it's actually going to show longevity when it comes to funding, all right? So because I need to tell you all this so you can understand the funding. Then you have your tier 3, which is your credit unions, okay? Now with your credit unions, they may accept a lower score, all right? They may accept a lower score just like with your tier 2, all right? But again, no revenue in the business. Now, none of these have revenue in the business. However, your tier 2 and your tier 3, they'll give you more money with no revenue in the business. So that would be like Navy Fed, right? So Navy Fed is one of those institutions that would give you income, okay? Give you funding just off of your relationship. This is all about relationship. This is why this is important. Then you have your tier 4, okay? So your tier 4, these are more like your fintechs, okay? Now, them, they usually, it's not about the credit, it's all about the revenue in the business, right? It's about the revenue in the business. So then you would be looking like at PayPal. PayPal would be one of your ones. You would be looking at On Deck. On Deck would be an institution like that. you would be looking at Lindio. Okay. Now, most of the time, again, most of these, when it comes to the business, is all about the revenue in the business. If you're not going for credit cards, it's about the loans and lines of credit. It's about the revenue in the business. All right. Then you have, now, again, like I said, understanding that if you're trying to sell off an LLC and stuff like that, it can become more challenging. All right. Now, I have a client. Here's the situation that I want to share with you all so you can understand this. All right. So him and his business partner, they formed an LLC together. All right. The business partner died. Okay. Now, here's the thing about it. The business partner died because his name was actually on the company. I don't care if they don't do anything in the company. The family of that business owner is entitled to the profits of that business. That's the reason that I tell people you have to be very careful in terms of when you're setting up these LLCs and stuff like that. Because imagine you built something up and somebody, a relative or somebody that you don't get along, and his family comes along and say, hey, I want to be a part of this. You can't say, If his family's entitled to it, he can get a part of it. So my thing was trying to tell that person, if I were you, I would dissolve that company and start another entity to separate myself. He didn't want to do it, so he'll pay the consequences down the road. That being said, let's talk about this C corporation and why I love them. All right. Now, here's the thing about it. People think C corporations, they're too complicated. You get double taxed and everything like that, right? Well, here's the thing about it, talking about double tax, all right? So these profits from the C corporation, you can keep them in the company. You don't have to take a salary. The reason why I tell people to set up a payroll and their corporations and stuff is because to have the corporation cutting you a check personally and having that deposited is showing that the company is actually profitable. And it's very important because it's going to help you raise more capital. All right, this is why I continue to tell you that. If you have a loss in the C corporation, you get a tax refund. The company can get a tax refund. But again, I do not encourage people to take a loss in the business. Even though I pay 5 figures in taxes, at the same time, I still do not, and I'm pretty sure I have enough expenses to write down to where I can take a loss in the business, but I won't. I'd rather show a profit in the business so that I'm able to raise more capital. All right. And again, like I said, with payroll and things like that, that's the reason it's important, because now you are showing legitimacy in the business. That people were like, well, you have to have these shareholders meetings and stuff like that. Let me tell you something. There's an issue going on right now where now this FinCEN, right? It's the police for the IRS, and everybody that owns any type of an entity, S Corps, LLCs, C corporations, okay, those type of entities, they have to file, it's a form, and if you don't file this form, yes, they will start penalizing you $500. However, my thing on it, all it is your statement of information. That's all it is, excuse me. It's just your statement of information that you would normally file every year to the Secretary of State. I just thought it was a waste of money, because if you own a corporation and you're up to date on your taxes and everything, you're filling out this statement of information. Now, what this does satisfy your board meeting, because your board meeting basically is this, okay? It just states that, hey, There's no new employees in the company. My address hasn't changed. The company name hasn't changed. The phone number hasn't changed. So there was basically no change. That's your statement of information. Okay? That's actually represent as your board meeting as well. Right? Because you didn't issue out any shares of stock. So this is why a lot of, again, attorneys and CPAs and stuff, because I get people, oh, my attorney or CPA, why are you on the phone with me then? Because if they have that much knowledge, then they should have been that simple with you. This is what I'm talking about in terms of, yes, people hold titles and stuff, but the level of knowledge and understanding about actually operating a business is not that good. You know, yes, they can read and they can file paperwork and stuff like that. Even like bigger companies and stuff that are bigger than mine, they just have a bigger marketing budget. But at the same time, their staff is just paper pushers. That's the reason they can't explain to you from LLC versus a corporation. That's the reason they can't explain that to you. All right. Now, here's the thing about it. Not only does your statement of information with the corporation satisfy your board meeting. All right. Now, if I want to sell my corporation with my credit accounts and stuff on it and stuff like that, it's much easier for me to transfer everything over to a company. This is why VCs, venture capitalists, like this type of structure, because it's so much easier to transfer everything over. So there's, again, not having to worry about the challenges, the hiccups, who else owns it, this and that or whatever. No, this is much easier for them to buy into, okay? It's much easier. Now, another thing that you also want to understand is that, like with fringe benefit. So basically, that's like your health savings account, your accidental and death type of insurance, dental, retirement plans and stuff. You have more fringe benefits, which can end up being write-off to reduce your overhead under the corporation. You don't have that many fringe benefits over here in the LLC. This is another reason why they are overstate their expenses, because they don't have as many fringe benefits to actually write off to reduce. All right. So then they have to make up. So I still can write off like my mileage and my travel and stuff like that, just like the LLC, but I still have more fringe benefits to the corporation. So I'm able to do more with this here entity versus the other. Now, here's the best. Growth. This is the main reason that you want this here, because when, and it's written, if you look at the actual tax laws, corporate laws, financial institutions, corporations, they look them as growth companies. That's what they look at them as. And yes, you can be a one owner of a corporation. This is another fallacy. Most people don't think that they can't be a one owner of a corporation. You can be the secretary, the treasurer, the COO of the company, the CEO of the company. You can play all of those 4 positions. There's really 3 main positions, which is the president or CEO, the treasurer, and the secretary. Those are your top 3, okay? Those are your top 3. And you as an individual can play all of those positions in the company. And most people are not even aware of this. Again, because we think about starting a business, setting up a business and stuff like that. And like I said, we're so hooked on people with titles, CPAs and attorneys and stuff. And then these big companies with marketing budgets, we never get a chance to ask the real questions about how one is better than the other. How is this going to help me with my legacy? Most of the people, when they're going this way, they're building something. So when they pass on, that their family still will have the opportunity to run the business, to keep more income in the business and stuff like that. Why is this here, this LLC, the reason why so many mom and pop stores are having such a hard time is because not only the structure of the business, but most of them, they're not even structured at this level. They're still like sole props, right? So they're still sole props. So every piece of income that comes into the business is going in their pocket. It's not being transferred to the banks. So then the banks can't prove that you have revenue in the business in order for them to give you funding. This is why people are having so many challenges. One, because they don't understand one structure from the other and the benefits of it. Number two is they don't understand why payroll is so important, why they should, because they have family members working the register and all like this stuff. You know, I need money. Take it out of the cash register, right? And they don't account for it. So every time that they need money coming and stuff like that, because they don't have actual records in terms of like receipts and all this stuff, they're not keeping that. That's the reason why business credit cards can be a benefit to a company, because your business credit cards, you can keep all of your transactions. You don't have to keep the receipt. Paying with your business credit card and stuff keeps all of your transactions in place. But people are not operating as businesses. They're still operating as side hustles. And the reason they're doing it is because they don't want to register their business because of this and this. But not realizing if you properly register your business and you operate it the correct way, you will be able to get more of this. This is what you want to help the business keep growing, right? So if you guys have any questions about business credit funding, personal credit funding, removing negative items off of the credit, or even how to even buy your corporate kit that I was showing you, click the link in the description, schedule a one-on-one consultation. Thank you.